Live, bringing you the first rate cut of the Trump cycle, absolutely live. The rate cut has come out and we've got it. It's 4.25%, 25 basis point rate cut, exactly as we anticipated. We got the rate cut, the first rate cut of the Trump cycle. But remember, it's not about the rate cut here. It's about a lot of other things that are coming out in this rate cut. It's the dot plot. Here we go. The dot plot coming out. Let me see here. Okay, so the Fed cuts rates by 25 basis points. A narrow majority of officials penciled in a total at least 3 rate cuts this year, which means we're still expecting 3 rate cuts this year, which is absolutely huge. Here is the dot plot coming in right now. Dot plot is over here. There is the dot plot over here. The dot plot just came out now. And there we go. Okay, so the dot plot is also out at the moment. Guys, if I'm live on YouTube, just give me a like, smash a like here. And just give me a sign in the chat, guys, and just tell me that I'm live in the chat, because I'm not sure if I'm actually live on YouTube. Okay, so I am live on YouTube. Everyone's telling me I am live on YouTube. Fantastic. So Fed cuts by 25 basis points. A narrow majority of officials pencil in at least 3 rate cuts this year, a total of 3 rate cuts this year. Statement changes dovish. That's great. And the Mirren is the only dissent. One person dissented and wanted 50 basis points. Okay, that's amazing. That's great. That's happening there. Here is the dot plot. Let me just open the dot plot for us now, so we can actually see it. In fact, you can actually see it here on this dot plot here. So one of them seems like a bit of a rogue, looking for a little bit of rogue rate cuts. As I mentioned, we are live on Pump.fun. We're bringing you and by the way, all the creator rewards that we make on Pump.fun today, we're going to be giving to other streamers and we're going to be giving to our community. So stay tuned. We've already made $11,000 in creator rewards being live on Pump.fun. And we're going to give it all to the community on YouTube and on Pump.fun. So keep watching. So quite interesting, because I guess Powell's in a bit of a caught between a rock and a hard place. He's got Trump telling him he better well bloody cut rates. I made a video on one of our other channels, Crypto Insider. I don't know if you guys have checked out Crypto Insider, but I broke down exactly why we're actually having rate cuts today, right? And the reason why we're actually having the rate cuts today is not because the economy is good. It's because they basically sabotaged Powell and they ambushed him to actually do the rate cuts. And eventually they took control of the actual data. So when the data, because Powell kept saying, look, I'm all about the data. And he basically turned around and said, okay, well, you know, if you're all about the data, we're actually going to put our own people in the data. And that's exactly what they did. That video is this video over here. If you guys want to watch it, it's on the other channel, on Crypto Insider, on the other channel. In the meantime, let me have a look here. So we have got the cuts. We have got the cuts that have now come in, 25 basis point rate cut. Dot plot, we know the dot plot. The dot plot has changed. This is the dot plot that happened in just before the election. And when the jobs numbers were revised down just before the elections, the Fed actually lowered rates by 50 basis points. So it's quite weird that they lowered by 25 basis points now after not lowering rates for so long. They now lowered rates only by 25 basis points. It really begs the question whether the Fed is becoming politicized or not becoming politicized. I did see Jamie Dimon, who came out a few minutes ago. Let's just quickly see if I've got that tweet. I think that Jamie Dimon came out and he said he doesn't really care because he does believe the Fed is currently non-political. I'm not sure if you can still count on that. Guys, do we have that tweet? Researchers, do we have that tweet about Jamie Dimon saying that the Fed is not political? I think that's quite a key tweet that we should be looking at. Let's look at what happens when rates actually cut, specifically for when the interest rates cut within 2% of the stock market all-time high. Within the next year, every single time, the S&P is completely bullish. Let's see what's happening right now. So Bitcoin is up at 116,215. Let's look at the SP 500. It kind of begs the question whether a good dot plot was actually planned. Look at that. Look at the S&P 500. I mean, it looks like a lot, but it's about 30 points because we're on 3-minute charts, and that looks quite big over here. Let's look at the Nasdaq, the NQ. Nasdaq NQ. Nasdaq unchanged. So basically, markets were expecting exactly what they got. It's going to come down to Powell when he speaks in about 25 minutes. Obviously, we'll be live here talking about understanding exactly what he says, etc. Let's breaking it all down. We do know that within 1 year, hardest I'm getting in my ear. I'm getting Pump.fun echo in my ear.
Okay. Sorry.
All right, so we do know that within 1 year, they do cut, the markets actually go up completely. We also know that within 7 days, if there's a 25 basis point rate cut, this is put together by researchers, but when there's a 25 basis point rate cut, within 7 days, Bitcoin always lands up being positive, or the majority of the time actually lands up being positive. If it's a 50 basis point rate cut, which I said earlier, we're lucky we didn't get a 50 basis point rate cut. And the reason why we're lucky that we didn't get a 50 basis point rate cut is because that would have signaled to the market that the Fed is really behind the curve and that the Fed is panicking. Now the message we're getting to the market is, look, we've got it under control, 25 basis point rate cut, and we continue to go to Valhalla. And I kind of think that unless Powell says something really, really, really hawkish on the mic when he's on the press release, I really do think that maybe this is the beginning of starting to go. Are we live on Pump.fun, Horace? It's crashing, eh? The Pump.fun stream keeps. Oh, Pump.fun! But we made $13,000 in rewards. We're going to be, we will be doing this. We will be giving this all away to the community today. Smash the like button, get people on. Horace, you keep trying to get us on, yeah? Okay, Horace is trying his best.
Fighting.
Here's the FOMC statement. What does the FOMC statement say, and what are the changes? Well, although swings in net exports continue to affect, the data has been removed. Recent indicators suggest that the growth of the economy activity moderated in the first half of the year. Jobs gains have slowed, and because of the revision of the data, and the unemployment rate has edged up, but remains low. Inflation has moved up and remains somewhat elevated. So that's a little bit hawkish, but not serious. The committee seeks to achieve maximum unemployment and inflation at a rate of 2% over the long run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its muled mandate and judges that downside risks to unemployment has risen. That's quite big because that's about the jobs numbers revised down. In support of its goals and in light of the shifts in balance of risk, the committee has decided to lower the target rate by a 0.25 percentage point from 4 to 4.25. In considering, and they removed the words, the extent, the timing of the adjustments, the target range of the federal fund rates, blah, 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 blah. They didn't change anything there. So basically, that is the changes in the statement. Nothing too major. Powell remains very focused and very data-driven and very, what's the word I'm looking for? He's unexcitable. Let's put it this way. He's unexcitable. I'm getting some more stuff here on the newsroom. By the way, I want to actually switch on the news terminal here because it's quite interesting to see what the news terminal does during an FOMC, right? So this is the news terminal. The news terminal basically allows you to trade directly off the news. Okay, so you can see now that the news terminal basically pings me every time that there's new news from sources in the market and allows me to trade directly from the coins. We'll look at it just now if anything actually comes out. All right, Fed Governor 𝗫𝗓𝗓 dissents in favor of half basis of 50 basis points. So 𝗫𝗓𝗓, one of them, dissented and said we should have done 50 basis points. I think that's true. They should have done 50 basis points. Okay, so Fed cuts rates by 25 basis points. Trump's pushes for more. Crypto markets eye liquidity boosts. And you can, the news terminal is actually flashing here. We'll leave a news terminal on for a while we get back to actually, to going back to all the actual data that's actually happening. Every time that pings that there's a new week. Okay, biggest news of today. Here's the biggest news of today. What is the biggest news of today? Here it is. So the biggest news of today is the dissent from one of the Fed members saying he or she, Governor 𝗫𝗓𝗓, dissented in terms of they wanted 50 basis point rate cuts. We need to listen up to what Powell says about quantitative easing because remember, in 2019, the quantitative easing is what actually sent the markets up. And they hinted in March that they would reduce the quantitative easing and they ended in September. Now, here we are again, and they hinted in March that they started to reduce QT. And so now let's see what happens if they're going to quantitative easing. You see, now the terminal is going crazy. So we'll go back to the terminal. Intel cuts by 25%. Median outlook is 50 basis points rate cuts more this year. 2 more rate cuts this year. One governor dissented, wanting 50 basis point rate cuts. 6 officials see no more rate cuts this year. 9 see 2. Okay. Spot gold hits a record high. Now, if I wanted to buy gold directly off the news terminal, literally all I would do is hit that. bang, I'm long $1,000 worth of gold. Okay, but I don't really want to be long $1,000 worth of gold. You can see that that trade is now sitting in my news terminal. Over here, you can see, let me just get onto the news terminal, and you can actually see the actual trade over here on the bottom of the news terminal. You can kind of see it. In fact, let me show it to you more like this. I love trading this news terminal. I think it's like a big advantage in trading. Okay, so I'm down 30 cents on my gold trade. Breaking, new Federal Reserve member, Miran. I wonder which dot is Miran's. Okay, we know what that. So you see the news terminal is actually feeding me with a lot of news, and it's allowing me to trade from the actual news as soon as it comes out. The thing about trading news, and specifically when you're trading things like the FOMC, you need to be fast. And that's why you can see the delays here in milliseconds. Like this is a 306 millisecond delay. So literally this news terminal has become one of my most powerful tools when it comes to trading, because it tells you exactly what tokens are going to move and allows you to long or short them from the terminal in a matter of milliseconds, right? So if you want to sign up for the news terminal, there's actually a special offer. It's the launch offer that we have. And if you want to sign up, you sign up here, and then you get the news terminal for $99 a month instead of $499 a month. And then if you carry on your subscription, you're going to get it for $199 a month instead of paying $499 a month. So it's a massive, massive, massive offer. And remember, with news trading, you always want to be first. You always want to be first. Hardest, how are we going on Pump.fun? Are we live?
It's on.
We're on. You mastered it. All right, so our Pump.fun coin is live. Here we go. We are live on Pump.fun. Here we go. That's us streaming the first FOMC ever to Pump.fun. It does look like their site's a bit glitchy and a bit slow, but hell, we're bringing it to you. Right now, we've got $13,000 in creator rewards, which means we can give away that $13,000. Anyway, let's go back to the data. We need to look out for what's happening with quantitative easing and quantitative tightening. We need to look for what Powell said. Last FOMC, or 2 FOMCs ago, Powell said that they are stopping quantitative tightening because they were worried about the Treasury General account. That the Treasury General account is an account that the government has been spending on because they reached the debt limit, right? So because they reached the debt ceiling, they needed to spend money, and they spend money from this thing called the Treasury General account. Once they finished spending it, they then had to refill it. And they started refilling it. I think the information I have, as you can see, is that they've already refilled the Treasury account, which means that now there's more liquidity in the markets, right? It means that now we are getting much, much, much more liquidity into the market. Guys, if you are here, drop your Solana address in the chat, because I'm going to have to start giving away these rewards, and we're going to have to give away all these rewards. So drop your Solana address if you're watching, and maybe you'll be lucky if you're watching on Pump.fun. Also, drop your Solana address. Yeah, we are going to give away those rewards. Another thing which might come up today is that up until now, the Fed's mandate has been inflation and unemployment, right? So their whole mandate has been they've got to protect the US against high inflation and high unemployment. But there is talk that now they're going to introduce a third mandate. And the third mandate is effectively called yield curve control. So I saw this on a tweet from 𝗙𝗧𝗪 earlier today. He said, with the Fed board member Miran, which by the way is the same one that dissented, you can kind of see which side this Fed board member leans on, right? Now confirmed, the MSM is preparing the world for the Fed's third mandate, which is effectively yield curve control. This came out from Bloomberg, I think, in an article. And what this article basically says is it says the Fed's dual mandate of price stability and maximum unemployment may be supplemented by a third mandate to pursue moderate long-term interest rates, as cited by Donald Trump's stock pick. The mention of the third mandate has sparked some debate amongst analysts, with some seeing it as a sign that the administration intends to wield monetary policy to influence longer-term bond yields. The potential for Treasury yields and the Fed to intervene in the market to bring down the long-dated interest rates has raised concerns about the risk of adverse policies. Basically, what this means is that the Fed can now go into the market and buy and sell bonds as necessary using Fed funds to control the yield curve. It's very similar to what they do in Japan. In Japan, they have what they call yield curve control. And what that yield curve control actually is, it's a mechanism that allows the Fed to buy and sell treasury yields, bonds, to control long-term interest rates. If that happens, this could be very, very, very good for crypto. So that's something that we need to look at. let's just look at our crypto chart. The market didn't like something. What didn't the market like? Why did the market drop? Researchers, if you can just give me, okay, so here it is. QT actually continues. That's I think that is so that when there's no quantitative easing at this stage, QT actually continues. The committee continued to reduce its treasury holdings and agency debt and agency mortgage-backed securities. And that's what the market didn't like at the moment, that the QT is continuing. And we wicked just below 115,000. Remember, we started the stream at about 116,234. So now everything is in Powell's hands. We are getting some more stuff here. I'm reading to you as I see it because it's coming out on the news terminal. Okay, the market also doesn't like the fact that the Fed is so undecided. So the massive disparities across the markets on total Fed interest rate cuts. CME has 3, 𝗙𝗘 has 3. The market's very, very, very undecided. So the market wants clarity. We're probably going to get that clarity when Powell goes live. That's going to be in 14 minutes. So in 14 minutes, I see you guys dropping Solana addresses. That's amazing. After the stream, we'll choose some Solana addresses and we'll drop them. We'll also drop some for other Pump.fun creators. So far, our Pump account is on $13,500 in creator rewards. So we're going to be giving all of them away. We're not keeping 1 cent of those. And we don't own any of this token, by the way. We just launched it for fun to play this event. Yes, the TGA account's full. We're looking out for quantitative easing. So far, the Fed carried on with quantitative tightening, unfortunately. That is why markets are not happy at the moment. That is why Bitcoin currently trading. Okay, it's coming back. I suspect by the end of FOMC, Bitcoin is actually back. What else is there? Should we look at some altcoins? Yes or no? Should we look at some altcoins while we're actually waiting, or should we look at the chat? I think one of the altcoins that you have to look at is you have to look at BNB and the BNB ecosystem, right? And the reason why the BNB and the BNB ecosystem is running so fast is something that we actually broke in our front runners yesterday. And that is that CZ Binance actually removed the word X Binance from his Twitter profile. And he replaced it with Binance. We picked that up in Frontrunners. This was the first announcement that actually happened. It actually happened very, very, very fast. And we picked it up and we posted it for our community in Frontrunners. A couple of hours later, we saw a thing here that said Binance in talks with the Department of Justice to drop oversight requirements in settlement. And also, we believe that 𝗙𝗍 is going to get a presidential pardon. So if that actually happens, yeah, someone says smash a like, guys. We are 8,694 people here. That's amazing. That's a full house. That's a full house. So this is what changed. 𝗙𝗍 Binance removed X Binance and made it Binance. And then the oversight, they're negotiating to drop the Department of Justice oversight, which is one of the conditions that they had when 𝗙𝗍 did that settlement and effectively ended up for 4 months in prison. And so now that sparked off a big Binance season, right? Some of the things that you can see in the big Binance season, one is this MYX, which is running 7 to 1729. On top of that, there is a new stable coin, which is by the co-founder of Tether. He's not at Tether anymore. He hasn't been at Tether for a long time. But he launched a new stable coin, and this thing absolutely ripped. We also caught another one here, right? So today on Frontrunners, one of our researchers, Lucky, he actually posted and he said, Astar, it's a perpetuals DEX. And he told people it's a perps DEX on Binance and you want to be buying it. That was at a $560 million FDV, right? That was when this call was made. Now, that token is already 4x today. Can you believe it? That's 3x now today. At the same time, we've got some kind of CZ endorsement. He says, well done, keep building. And he points to this Astar DEX. A lot of people are speculating that this could be a competitor to Hyperliquid built on the BSC chain, and that 𝗙𝗍 and his investment company or his family office may actually be behind it, right? We caught that in Frontrunners. That's a 3x today. We also caught the other moves because we caught the 𝗙𝗍 Binance thing in Frontrunners. Guys, I keep begging you, just join Frontrunners. Just join Frontrunners. It'll cost you $99 to join. Literally, $99. Try it. It's where we share all the alpha as it happens. Those guys today made a 3x. Join it. You pay $99. If you're unhappy, you can leave after 30 days and you get your money back. It's like literally the easiest way to make money in this bull market. Try it. If you don't like it, literally you can get your money back. Literally. All right, let's see more stuff coming in. Here's the Fed projection policy. Let's see what's actually what the okay. Economic projections as per the Fed. I think Powell will take us. Okay, the 10-year yield is falling. That's very, very good. That's the US 10-year is starting to fall. Bitcoin is at 115,411. Let's look at the US 10-year. US 10-year, we want that. It's at 4%. It's okay. It's actually rising back now. I'm looking at 3-minute charts here, so it's moving pretty quick. So it hasn't broken below 4. Let's look at the US 20-year yield. So the US 20-year yield is at 4.5%. We want to see those go down as Powell starts talking. You have to forgive me. I'm on a 5-day fast, and this is my 3rd day, and all I'm drinking is herbal teas. So, I mean, I think it's a miracle that I'm actually here. All right, 9 minutes to go until Powell speaks. I see you guys are dropping Solana addresses. We'll deal with those later or tomorrow, and we'll drop all the creator rewards in the Solana addresses, so keep dropping them. Sabari says, loves the show. Sabari, thank you. I am here, bring you crypto love and crypto wisdom. I wish you guys knew how hungry I was. I'm fucking starving. You can't even understand how hungry I am. By the way, if you haven't already subscribed, there we go. The subscribers are climbing. Subscribe to the channel. Let's go. Anything else that's happening? Let's see what else is happening. I mean, we can always just check the newsroom, or we can just check the news terminal. Let's just look at the news terminal. Let's watch this for a few minutes while we're waiting for Powell to actually come on. New news came out here. Arbitrum, some news on Arbitrum. Alpha. See this, it comes, as the news comes out with a 179 or 66 millisecond delay, you guys are getting the news and you're getting the ability to trade from it live. So let me close my gold trade. I don't feel like being long gold. Closed. And let me close my 𝗙𝗚𝗎𝗓 trade. Even that, in fact, I'll keep that trade open. It's a small trade. All right, waiting for Powell to come on. We've got about 8 minutes until Powell comes on. Someone says the dip is recovering. We can look at Bitcoin over here. Let's look at Bitcoin over here. 11. I think when Powell's finished speaking, Bitcoin will be back up, but we have to wait and see. Sherry the DJ, I see you. Someone says Peak. That's Glenn Goldberg. Yeah, Peak's all about robotics now. That's why they've got a good bid now, because they're all about robotics, and they are blockchain for a deepened blockchain, and robotics actually falls into that category. So that's a good one. Surely that the sound isn't necessary. Yeah, look, the sound just tells you when there's trades coming. I'll switch it off for now because we can't listen to Powell when the sound comes on. I mean, by the way, we are here live waiting for Powell to come on. That's the stream from the Fed, and that is the stream from YouTube. Good music. I wonder who does the music. Okay, we'll mute that. All right, GDP forecasts are up, unemployment forecast down, PCE forecasts up. That is what we are getting from the let me open that for you so you can see that's coming from the newsroom. So what it says is you've got the GDP forecasts basically going up. You've got the unemployment forecast also going up. Unemployment forecast down. So moving down, GDP forecast actually going up. 25, 26, 27, 28. Unemployment, 25, 26, 27, 28. Expecting higher PCE inflation in 25. They're expecting a 3% PCE inflation in 2025. But at the same time, also expecting 3 rate cuts. This is becoming pretty interesting. Can't wait to hear what Powell actually has to say there. US 10-year yield falls to 3.99. It actually that's the US 10. That's the US 20. Let's look at the US 10. Falls to 3.99. Let's have a look here. Okay, it did actually hit 3.99, so it did break 4. That's very good. So you probably want to look at like the TLT here, because the TLT likes it when long-term rates drop. Let's see what that TLT is doing. 90.72. So it is up slightly. It started at like it's very, very slight. Very, very slight. All right, we are live in 5 with Powell. Come on, bless me, bro. I'm not gonna do it now because I have to access the Solana wallet. Also, Pump.fun streamers, if you're there, we are going to be giving away a lot of the rewards. $13,000 of rewards. Imagine that. Just watching a stream, you get rewards. Can you believe it? Just watching a stream, you get $13,000 worth of rewards. Just watching a stream. Can you believe it? All right, more. I see, geez, the Fed has cut rates to 4 to 4.25. Thanks for the SOL. Yes, you will get the SOL. Some of you will get the SOL. Let's look at some other altcoins that are actually running. This DEX, which was called in Frontrunner, what an unbelievable quote. It was called at 7 cents. Now it's at 18 cents. This was called a couple of hours ago. Yeah, a couple of hours ago. That was caused by one of our guys in Frontrunners. Remember, guys, if you want to join Frontrunners, you join, you don't like it after a month, if you don't make your money back after a month, you can have your money back. Literally, just send me an email and I'll give you back your money. Go and do that. Also, sign up for the news terminal. If you sign up now, $99 for 3 months and then $199 a month. Like you've got to be in the game to get that. All right, what else is happening? Let's go. Let's see what's going on. Let's go into the Banter Bubbles newsroom and see what else is actually happening there. I'm so tempted to short this MYX. Should I short it? It's crazy. I know this coin is cabal controlled. That's the problem. Okay, not much movement on the bubbles. Everything watching Bitcoin. Bitcoin 115,800. So climbing back. We're watching it here on the 3-minute chart. I think what we should do now is we should actually start prepping our screens for the way that, Powell streams. I like to watch multiple screens at once. So then we're going to watch Bitcoin dominance. We're going to watch the Bitcoin chart. So let's watch Bitcoin and we'll watch Bitcoin dominance. I really hope something happens here because the last couple of FOMCs have been kind of boring. I'll be honest. Like Powell's let us down from a content point of view. He's let us down a lot. And then let's look at the NASDAQ. So let's get trading view and let's get the NASDAQ in here. It's not that one. It's in there. NQ, there we go. It's that one. All right, so now we have these 3 screens. I'm going to set it up so when Powell starts talking, we've actually got all 3 of these screens open. We don't need that. Okay, they're all going to be on very low time frame charts. So bear in mind when you're watching, if things look like they're going out of hand, maybe they're not actually going out of hand. It's maybe just because we're watching on 3-minute charts because we're degens. Okay, let's try and get this into one screen. There we go. Okay, that is our Bitcoin chart. And let us get the NASDAQ chart here. The NASDAQ chart right over here. And we can actually make these a bit bigger, a bit wider. Give the guys a big view of what's actually going on. Powell's not live yet. Someone's asking. Powell's not live yet. The Bitcoin dominance chart over here. We're getting ready for the mother of all streams. All of them are in 3-minute time frames. And I'm going to pull the Fed over here. Let's get the Fed onto that time frame over there. Let's get it on here. All right, we're waiting for the Fed decision. No real news starting to come out yet. This is the Fed. This is a live stream. I mean, I could have chosen a better song, right? Yeah, I'm going to mute that because I don't think we need to listen to that music. Not really my kind of music. I'm much more an EDM kind of guy than, Okay, let's see. Let's see Mr. Powell. Powell ready to stream. I pretty much read you the beginning of his statement. So now it's just, all right. Oh, man, come on. Someone says it started. It hasn't started. He starts at half past. And this is live, by the way. All right, so now we've got Powell. We've got Bitcoin dominance. We've got the NASDAQ. We're all ready to rock and roll. By the way, the odds for the next FOMC, 93.2% chance of getting another rate cut in the next FOMC. 9,700 viewers. Baby, let's go. Smash the like button, guys. Let's get going. Wow. 9,700 viewers. That's a big number. That's a huge number. Hold on. Let me get some more charts up here. We need to get some more charts up here. By the way, we have more people than CNBC watching us right now. Right here. More people than CNBC watching us here. Let's have a look here. All right, let's keep going. Let's rock and roll. Okay, is Powell live yet? Okay, you should be live now. What the hell's going on here? Who knows where Powell is? Let's just click. Yeah, oh, he is live. He just isn't live on the Fed side, so we'll watch it here on YouTube.
Remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen.
What the hell's going on here?
At the same time, inflation has risen recently and remains somewhat elevated.
He just isn't live on the Fed side, so we'll watch it.
In support of our goals, and in light of the shift in the balance remains low, it has edged up. Job gains have slowed, until downside risks to employment have risen. At the same time, inflation has risen to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June.
No surprises.
As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
All right, here we go. Questions.
Great. Thank you. 𝗙𝗰𝗙 at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Thank you.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that.
Someone
but
says, "Where's
we do
Gina?
know that
Let's
they've
wait for
moved
Gina. Let's wait for
meaningfully
Gina."
toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted?
Good question.
And how seriously
Good
was
question.
that
Now we're
option
talking.
entertained
Now
at
we're
your
talking.
meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that.
The
At the
market
same
seeing this
time,
as
we've
kind
got
of
to weigh the
hawkish, which
risks
is
to
kind
the
of
two
weird.
goals. And
Very
I would
weird.
say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
I mean, they're sending all the immigrants back.
Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth 𝗙𝗆 with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job.
I mean, that
right
Bloomberg
now,
guy, he's got to be short. The only reason you could be fighting a market like this is because you've got to be short. I guarantee you that guy's short.
It to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them.
You ever notice that Powell's wearing a purple tie? You know why he wears a purple tie?
Says that when our two
because it's a
goals
mix
are in
between
tension,
red
this
and
is
blue,
quite
which
an
is
unusual
Democrats and
situation.
Republicans. And if you
How do
mix
we
red
decide
and
what
blue
to do?
together, you get
Because
purple.
our
That's why he
tools
always
can't
wears
do
a
two
purple
things at
tie.
once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And
this is scary because this could mean stagflation. It means that the Fed might be caught between a rock and a hard place. When you're getting unemployment up and inflation up, that's a problem.
But it's also partly about
unemployment down
thing
and inflation up.
In light of this, of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, 𝗙𝗏𝗪𝗏 with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just, everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment.
Oh, he dodged that bullet.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the 𝗙𝗍, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates?
This guy's asking the right
should have been
questions. He's asking the right questions.
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Live life through the windshield, not the rearview mirror.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that.
Look, it doesn't look good for the altcoins.
Minorities, unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two
Very interesting words.
We're getting unusually large amounts of economic
Trump is
activity
putting a
through the
majority into
AI
the
build out
Fed.
and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think.
I don't even want to get much more from Powell. I think he's pretty much made his course. 25 basis point rate cut. Everything else remains exactly the same. Let's just quickly check in on all the stats as they come in. So we have the Nasdaq down about 0.64%. We have Bitcoin slightly down. Remember, we started at about 116,500. We're back up at 115,350. There was no new news, and it's pretty much everything that everybody expected. So now I think it's basically in the hands of the market to see where this thing actually lands up going. I see Pump.fun actually moving up quite nicely. Let's quickly just look at the altcoins. Before we go, let's just quickly take one last look at some alts. On the altcoins, let's just go onto the altcoins. You can actually see them live on the bubbles, banterbubbles.com. MYX up 1790. Wow, this thing's flying. All the rest pretty much slightly down for the day. 𝗙𝗏, wow, look at that. The meme coin. Brian Armstrong's cat. 𝗙𝗏 up 50% today. That's crazy. Yeah, guys, remember the special offers that we've got for you guys. If you sign up if you sign up to the following, let me actually go there so that you can actually see it. So if you sign up to front runners today, you get a money back guarantee. If you're unhappy within 1 month, you get your money back. Now remember that there's so many amazing calls that came out of front runners. You can just see just today we had a 2.5x on Asta. Yesterday we had a whole lot of BNB related assets. Literally, if it's a $99 a month spend, if you're not making $99, just write me a mail and you can get your money back. It's that simple. Also, the terminal. This is your most powerful trading tool. Like, there is no more powerful trading tool than this terminal. Why? Because what it does is it feeds you the news before anybody else gets it, and it allows you to trade directly from the terminal, right? So as soon as the news comes out from multiple news sources, I mean, if you guys understood how this worked, there's an AI at the back which is scraping Twitter accounts and Truth Social accounts and other news sources, and it knows, because it backtests, it knows which tokens, which accounts move markets, and then it filters those accounts into the news terminal, and then ultimately you can trade directly from the news terminal within like 1 second. So like 𝗕𝗏, if I wanted to buy 𝗕𝗏, bang, I'm long $1,000 of 𝗕𝗏. I'm actually going to keep that long because I kind of like 𝗕𝗏, so I'm actually going to keep that long. Those offers are for you here in the description. Yeah, I mean, I think that's pretty much it for today. I think we'll see you guys again tomorrow for our regular streaming. Until then, trade well, my friends.